So Robert, let's start this week with payroll data. You're calling it moderate. Can you explain further?
Yes, Susan, I call it the Goldilocks report because it's not too hot at payrolls up 164,000, not too hot that would cause the Fed to want to raise interest rates even faster than expected if they thought the economy was heating up too much, and not too cold to signal a cool down in the economy. 165 is a little bit below the near 200,000 level where we've been, but it's not a bad number at all. In fact, I don't think we can sustain 200,000 consistently, much more. So 164,000, good number for the month. Unemployment rate did come down to 3.9, so it's getting into that very, very tight range. And that matters because as labor markets tighten up, now we're expecting wages to start picking up a little bit, even though we didn't see much of it in this report. But down the road, we do expect to see wages warming up, and that catches the Fed's attention because they're looking at wages to inflation and then raising interest rates, getting ahead of any kind of inflationary push. So all this data really matters to interest rates this year.
Robert, let's talk about manufacturing. Both indexes, non-manufacturing and manufacturing, eased slightly, but you say manufacturing is still strong?
Yes, now they've eased both the ISM manufacturing and the non-manufacturing indexes. Those are both very high early in the year, January, February, around 60, very, very strong numbers. So, the only place you go from a high number is down. So we would expect them to relax a little bit, but they're still solidly in the mid-50s, which means improving conditions. And there's absolutely nothing wrong with that and consistent with ongoing moderate GDP growth.
Also, the trade gap has narrowed. What's going on with imports versus exports?
Well, we've had a couple anomalous months here. Late last year, we had a surge of imports. A lot of that was fueled by the iPhone 10. One product can skew these numbers if it's a big enough import coming from outside the country. The other thing that skewed the data was the Winter Olympics. That we paid royalties and they were counted as an import because we're importing services. So we had a widening trade gap through last month. This month looks like the recent data for March looks like it's renormalizing. And in fact, that was pretty well baked into the GDP data we got earlier. They have to make an estimate on trade, and so I just back calculated at 49 billion, and we just nailed it. A little bit of a coincidence there, but you can back calculate that last trade number because the GDP data comes out before the full quarter is complete on the trade side. So I thought it was going to come down, which it did.
Last thing I wanted to ask you about is the next Fed meeting, which is happening in June. What can you tell us about that?
Well, we just had the last one here, and of course the Fed did nothing as widely expected, but that's going to change when we get to the June 12th, 13th FOMC meeting. Everybody and their uncle is expecting a Fed funds rate hike on June 13th, and the implied probabilities are up to 95%. That would be the second rate hike this year. September is looking pretty good, a pretty high probability for the third rate hike. So the discussion at the Fed right now is really, are we going to get the fourth rate hike in December or not? And that's maybe 50-50, a little bit less than 50-50, but I'm starting to lean toward number 4 because I just bumped my oil price forecast up and the inflation number is starting to look a little bit warmer. And as I said, these wage numbers, I do expect them to come up a little bit. So, if I could, split the baby here and go for 3.5, we're not going to get 3.5. We're only going to get 3 or 4. But I think the odds of 4 are starting to creep up a little bit.